Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required.
Hello and welcome to Live Squawk's Market Talk, our weekly review. Comes to you today on Monday, the 22nd of June, 2026. Every week, myself and guests break down the key stories of the week and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up as to what you should be looking out for. For this episode, I'm joined by regular contributor Michael Brown, market analyst and commentator. Normally you're here with Ryan Littlestone of Forex Analytics, but Ryan's gone AWOL. No, he's not around this week, so it's myself and Mike. But we'll try and keep the bands going. Before we get into it, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks. Past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Okay, we'll get straight into it because there's quite a bit to go through today. So in terms of the tail of the tape then, we had a number of central banks report last week. The majority kept policy on hold, but we have heard that, well, the sentiment seems to be one of a more hawkish nature, despite the fact that during last week's events, we were getting mumblings and ultimately an agreement to a ceasefire between the US, Iran and Israel, which is subsequently, we'll get onto, not really as maybe as shored up as we might have hoped it would be, and is rather looking rather tentative at the moment. We'll get into that as well in a minute. But we're recording this on a Monday morning. Normally we do this on a Friday, but thankfully we've done it on a Monday because quite a lot's happened between Friday and Monday to keep us occupied. And we'll start really, we're UK based. We're going to start in the UK because there's been some big news over the last hour at the time of recording that the current incumbent Prime Minister, Sir Keir Starmer, is set to stand down as leader of the Labour Party, the ruling party in the UK, which opens the door to potential leadership battle and a new Prime Minister in the near future. Mike, where do we begin on this in terms of what it, as I've said in the notes I've got, is this good for UK assets? And we'll we'll find out from you.
Well, yeah. Let me get my crystal ball out and work the answer out, mate. Very good morning to you on what is an incredibly hot day here in South London. It's heating up in Westminster as well. As you said, Keir Starmer resigning this morning. I think what's more important than that is actually what's happened since Keir Starmer's speech in Downing Street. And again, it's about 11:30 in the morning. So if you're listening to this later, things might have changed quite a lot. Since then, we've had obviously Andy Burnham throwing his ring into the contest to succeed Starmer as Labour leader. But more importantly, Wes Streeting, the former health secretary who was rumoured as a potential leadership challenger, he's now thrown his weight behind Andy Burnham and said, I want Andy Burnham to be Prime Minister. I'm backing him. I think the rest of the Labour Party should back him as well, which means that actually in contrast to what we were kind of expecting this morning, which was that this could be a leadership contest that drags on through the summer and potentially through to September, it's looking increasingly likely that this is actually going to be a coronation, ultimately, where power in mid-July is relatively smoothly passed from Keir Starmer to former Manchester Mayor Andy Burnham. And I think that bit in particular could be the better outcome for the pound, because you avoid, and for gilts, because you avoid, a couple of months of political chaos and uncertainty as the Labour Party throws around policy positions and has a protracted leadership contest. What I think is the slightly more debatable part, and the part that could and probably will pose headwinds to UK assets, is Andy Burnham now needs to flesh out his policy platform. What does he stand for? What are his plans, particularly fiscal plans? Is he looking at potentially tax hikes? What are his spending plans looking like? And also, who are the key personnel in that government going to be? Most obviously, of course, who is his chancellor going to be? And I think that is really where the focus will now shift for UK-based traders, if indeed it does become what is ultimately a certainty at this point, that Andy Burnham is going to take over towards the middle of July.
And also that certainty does extend to the fact that we are more than likely, because a lot of the disquiet has come from the Treasury and what the Treasury is trying to implement. Maybe in good spirit, it obviously wants to try and, be seen as a responsible entity within the economy, the UK economy. But the messaging has been very, very poor, as we've noted over the last 2 years, really. And you'd expect, really, that Rachel Reeves, the incumbent Chancellor, Finance Minister, whatever you want to call her, likely step down.
Yes.
Just a note here. I've got a note here from SocGen, actually. It's from SocGen. I think it's from Kit Chucks. That says UK is heading for its 7th Prime Minister. I can't even believe I'm saying this. 7th since the Brexit vote, which is 10 years tomorrow, isn't it?
Yeah, it is, yeah.
The FX market is not overreacting so far. Only modest sterling weakness is likely from here, taking euro sterling 1 or 2 percentage points higher, while cable, which is sterling dollar, is likely to test 130 this summer. Andy Burnham, Sir Keir Starmer's heir apparent, is likely to be in situ well before the Labour Party conference in late September. We're also told that he's discussing, as you said, who should be the next chancellor, a decision to which markets are obviously sensitive. Again, I mean, you pretended to that as well. Markets themselves, look, it's not a massive shocker that Sir Keir was stepping down, and we were likely to see a new leader in place, really. But like you say, next couple of days are going to be very, very interesting in order to see what this means in the sense for the Treasury, for the economy, and any warning bells that you have, or is it just a wait and see thing in terms of what we've heard from Burnham in the past and his approach to maybe growth and so forth?
Yeah, I think it is wait and see, because it's very easy to say something when you are not in frontline politics, when you're not even in Westminster. It's very easy to kind of opine from the sidelines. I think we are obviously waiting for details on what he plans to do. The two things that obviously you would kind of throw up as warning signs immediately are, firstly, that famous line from, I think it was this time last year, when Andy Burnham was saying that the UK shouldn't be in hock to the bond market. He has sort of tried to water down those comments since, but it's quite clear that is his sort of underlying fundamental belief, despite that being economically incoherent when you run a significant budget deficit. So he's got some work to do in terms of getting gilt market participants on side on that front. But I think what's also a little bit concerning is the comments we heard over the weekend from Lord Jim O'Neill, who's been advising Andy Burnham on economic matters. And he was saying that actually he believes that there is room for greater borrowing within the current fiscal rules if that borrowing is used for investment in things like infrastructure and such like. And I don't think the market would take that too kindly, because, again, it just comes back to that idea of effectively an accounting quirk to fit within the rules, when at the end of the day, more borrowing is more borrowing. And when you've got a government that lacks credibility with market participants already, the last thing you need is to increase borrowing on top of that. So I think it'd be interesting to hear what he has to say on that front as well. But only time will tell at the end of the day. We're kind of just speculating at this moment in time.
Absolutely. And just for those who don't know Sir Jim O'Neill, he was once Goldman Sachs. I think, was he chief economist there?
Yeah, I think he was. He was famous for coining the BRICS acronym, wasn't he, in terms of Brazil, right, Russia, India and China. And that's kind of what he's known for. But he's been in and around sort of Labour Party circles for quite a while now as well.
Yeah, absolutely. Just there's a note from TD Securities here saying near term we look for 10-year gilts to stay around range bound in the 4.8 to 5% yield level. We favour positioning for steepness as we head into August. Is there been last week? That moves us on to the Bank of England. So last week we had the Bank of England keep rates on hold. I guess they kept the hiking. Am I right to say hiking rhetoric? But just more, I think we've seen a little bit more on the hawkish side, really. There were two dissenters, 7-2 was the vote, two dissenters calling really for a hike in rates, although maybe that was for show, I don't know. But what are your views on what we heard from the Bank of England last week? It wasn't an MPR, so monetary policy report, so therefore we got less of a press briefing than we would normally get, I guess, on this. But it was as you were as such in terms of the interest rates itself.
Yeah, absolutely. And I think it was almost as you were in terms of the remainder of the meeting as well. Yes, it was a 7-2 vote. So you had Megan Green join Chief Economist Hugh Pill in dissenting for a rate hike. The April decision to stand pat was obviously 8-1. But the remainder of the policy statement and actually the minutes were relatively little change from what we heard last time out. I think certainly a majority of the Monetary Policy Committee outside of those two dissenters are still of the view that actually any policy restriction that they might have needed to have provided has come from the market pricing out the rate cuts that were expected before conflict in the Middle East started at the beginning of March, and that actually the bank don't need to do anything further. And of course, in the interim between the April and the June policy meetings, we've had not only the agreement of an MOU between the US and Iran, which we mentioned, but also actually inflation has come in a little bit softer than expected at 2.8% in both in both April and May. So although that is going to move higher through the summer as things like the Ofgem energy price cap come through and make their way into the data, I think the Bank of England are very much, or the majority of policymakers are of the view that actually they can probably just see through that move higher in inflation by standing pat, by keeping their guidance, as you said, that they'll act as necessary to get inflation back to target, but crucially over the medium term. And the majority of policymakers don't see much in the way of significant risks of that not happening. Inflation expectations are still pretty well anchored. There is still plenty of slack in the labour market. Private sector earnings are basically flat on a real basis now and at target consistent levels on a nominal basis. So I think, in many respects, yes, the vote split stood out. It was more hawkish than last time, but there was nothing else in that BOE package that they delivered us that would suggest that they're any nearer to pulling the trigger on a rate hike.
And maybe that was the purpose. They want to keep options open. They want to make sure that there's a bit of, that they're nimble and potentially can move, because the situation, the geopolitical situation, remains fluid. We're mistaken for thinking halfway through last week that everything had settled down internationally, and we were starting to see a bit of a return to normality for the energy markets particularly. And then obviously the weekend, we'll come on to this now, the breakdown of the goodwill, as I put it, and what we have to make of it. That's the next subject. So for those who don't know what's happened, last week we had this MOU signed between the US and Iran that would see a cessation of any fighting for at least 60 days, while they talked about the more meaty subjects of what to do about uranium enrichment, what to do about the Strait of Hormuz and the traffic that goes through there, who's responsible for it. It was all looking really, really good until Israel and Lebanon and Hezbollah decided to start chucking ballistics at each other again. And it's really put the whole of this peace agreement on shaky ground. There's been rhetoric over the weekend from President Trump, that's nothing new, and from the Iranians, again, nothing new there. From a market perspective, we've been here before, so I don't, and we've not seen swaves of market movement on this and lots of volatility, partly I think because the US was out on Friday for Juneteenth anyway, so the market shut. So there's a bit of reaction function going on through there. We may see more that come through as we head through the week. Really, how do you assess where we're at with the Middle East situation at the moment?
Yeah, well, it's certainly not easy to assess it, and I think the market is probably right to ignore that sort of rather bellicose rhetoric that we've had from President Trump, because that is really nothing new at this moment in time, and we seem to get that on a weekly, if not daily basis. So I guess if you kind of pull back all of the political spin and as much as you can, the key part of all this story is that, firstly, talks did take place between the US and Iran over the weekend, mediated by the Qataris and by Pakistan. And secondly, they appear, at least at face value, to have yielded some sort of a positive outcome. At least they've committed to this framework for further negotiations. They are going to have another round of talks, and in fact, technical level talks are happening this week. So that's all very, very positive. I guess the stumbling blocks and the potential problems come in, firstly, with Lebanon, because the Iranians seem to believe that Hezbollah and Israel are incorporated into this MOU, whereas the US are saying that that's not the case. So that is clearly an issue that has to be sorted out at some point. And the second thing to focus on is, we go back to that idea of basically counting ships and counting the tankers that are going through the Strait of Hormuz. Again, it's all well and good, the US and the Iranians saying the strait is open, but are ships actually transiting the strait? Is crude getting out of the Gulf at a more rapid rate than we saw previously? And I think they're really the key things for participants to focus on. Firstly, is the Strait of Hormuz normalizing to a degree? And secondly, are talks still continuing? I think, if the answer to both of those questions is yes, which as of right now, it seems to be, even if the progress on both of those is being made at a snail's pace, then so long as the answer does remain yes, I think market participants can kind of put geopolitics to the back of their mind a little bit. Although, as we saw over the weekend, it probably can't stay at the back of our minds for particularly long, given how volatile and fluid the situation is.
Just to say, yeah, we have to keep an eye out then, as you say, because this has been one of those sorts of situations where you maybe have to take a step back and look at this on the whole, as opposed to every fractious sort of headline that hits the wires. So one to watch on that one then as well. Going back to just quickly, as FOMC was last week, if it's almost forgotten about.
Feels like about a year ago at this point.
It does, doesn't it? And we saw the Kevin Walsh's first, as chairman, FOMC meeting with his former boss, Jerome Powell, still sitting on the decision-making panel, which is bizarre as itself in itself. What do you make of Walsh's performance?
Well,
his first,
I thought he did quite well. I think actually it was a fairly polished and confident press conference that Kevin Walsh gave after the meeting last week. I think certainly if you sort of compare that to how Jay Powell was doing in his first few meetings, I think Walsh was a lot more composed than Jay Powell would have been back then. But it is only one meeting, and there is still a long way to go. And I think what stood out to me was actually what Walsh didn't say, because all of the firstly, he didn't issue any sort of explicit forward guidance, which we know he is not a fan of at all, and the era of giving explicit rate guidance is probably dead. But secondly, any of the slightly difficult questions, whether that be around inflation, why have we've had inflation running above the Fed's target for so long, whether that be around the Fed's balance sheet or anything of that ilk, the answer was simply, well, we've got a task force to look into that, which is all well and good, and that's very interesting, and I'm sure the task forces will come up with some interesting conclusions. But, you can't rely on that excuse forever. At some point, you are going to have to give a proper answer to these questions. What I thought was also interesting was that there was quite a lot of punchy rhetoric from Kevin Walsh, really stressing that the FOMC will deliver price stability, really focusing on the inflation side of the dual mandate. And I think actually a lot of that tough rhetoric was probably aimed at ensuring he doesn't need to deliver tough action to back that up. If you can sound relatively hawkish in your first couple of meetings and get the market to reprice a little bit more hawkishly as it has done, that will tighten financial conditions for you. That will get you through the energy-induced hump in inflation. And it will actually mean that you've firstly restored and obtained a little bit of credibility. And secondly, that you haven't had to pull the trigger on a rate hike. And I think avoiding a rate hike is probably Walsh's number one priority at this point.
Which makes it ever more surprising. There's a note from Bank of America that says they've changed their call. Then they now expect the Fed to hike 75 basis points this year. Just to give you the takeaways to their report, they say we expect the Fed to hike by 75 basis points this year, starting in September. Sticky inflation will keep policy on hold next. The data call for hikes. Moreover, the June SEP, and Walsh's comments indicate a more hawkish reaction function than we thought. And we'll hear from Fed officials today in the form of Fed's Waller after the termed hawkish June FOMC meeting. Are you a little surprised the bank, such as Bank of America, are calling for 3 hikes this year?
Yes, I was very surprised when I read that note this morning, and I think also, I've never been one to place particularly much weight on the dot plots or the SEP, but since they've mentioned it, only one policymaker in that SEP has penciled in 3 rate hikes between now and the end of the year. So, and that was the most hawkish individual projection. So I am very surprised to see that. And I think also surprised when you consider, they cite some of the data in the US, and yes, inflation is moving higher, and CPI running at 4.2% is clearly too high. But it's quite likely that May number, if not the June number, will be the peak for this year, because energy prices and gasoline prices have come lower. And also the comparisons with the punchy inflation rates we saw in the back end of 2025, where CPI averaged about 3% a month on an annual basis in the second half of the year. That means it's mathematically quite difficult for inflation to continue to increase. And then on the labour market side of things, and I think we touched on this when we were last speaking, yes, we've had a number of solid payrolls prints, but certainly the May number, to what extent was that boosted by temporary hiring in the run-up to the World Cup? And how much of that is going to then fall off of payrolls? So, I think, there's a few in the market that seem to be getting a little bit overexcitable, dare I say.
And like you say, I mean, these are prone to change, these forecasts anyway, as the situation.
Well, I would love to know what Bank of America's call was at the start of the year, because I bet it wasn't 3 rate hikes.
No, that's true. And if I had time, I'd find it. It's also worth noting that we had Deutsche Bank in one of their economic notes here as well said, we're keen to hear from New York's Williams and Chicago's Goolsbee this coming Wednesday. As we also outlined last week, we believe Williams to be one of the 9 Fed officials not projecting a rate hike this year, while we see Goolsbee forecasting 50 basis points of rate increases. Recall that Williams also serves as the vice chair of the FOMC. Thus, we are keen to hear his outlook, how his outlook may be evolving, and whether his messaging is in line with that of Chair Walsh. To be sure, the market participants will scrutinise both Williams and Goolsbee comments, any potential insights into how the committee's reaction function may be evolving. So, I mean, we got Waller today, but as I said, and like analysts are looking at there at Deutsche Bank, Williams and Goolsbee on Wednesday may well be an event for traders to keep an ear out for. So one to watch on that. Moving on to US data, we've got PCE data. We start looking at the week ahead as we sort of round off today's episode. And that headlines as personal consumption, personal spend, and within that PCE data, within that, the favoured Fed gauge for the moment for inflation, US core PCE for May is due up as well. And I'm going to go by Deutsche Bank as well. They look for personal income to rise 0.4% versus unchanged. Consumption, they see a gain of 0.6 from 0.5. And on the core PCE, the latest reading on core PCE inflation, they see 0.37% versus 0.24%. So another rise there on that measure. And as they've outlined, they say, though May CPI data is somewhat positive given weaker core goods prices, portfolio management and foreign airfares and PPI more than offset that, leaving our track estimate of core PCE inflation somewhat. Sorry about that.
So you're a man in demand, mate.
Well, no, I think that's just Bank of America ring me up and give me no. What do you expect from this month's PCE reading? Obviously, we've had inflation data out and we've had PPI data out as well. So CPI, PPI, which fashions what we're likely and expect to see out of core PCE anyway on that front.
Yes. Yeah, exactly that. And I'm glad you said that, because actually it's one of those numbers that, yes, it attracts a lot of attention from a policy perspective, because for now, at least, it is the Fed's preferred metric for inflation, preferred inflation gauge. But that may be subject to change. And also it's one that, you've got the CPI, you've got the PPI, you've got import and export prices, and people much cleverer than me can put those into a model and tell us with quite some degree of accuracy what core PCE is likely to be, which is why you get forecasts to 2 decimal places like the guys at Deutsche have done. As a result of that, it's never a particularly significant market mover. You watch, it will be the biggest move ever now I've said that. But I think it just kind of underscores the idea that actually price pressures were continuing to tick higher in May. The market's focus now is really on what the June data is going to say. Did we actually see things start to moderate as we moved into the start of the summer? And is that going to be the start of a trend of moderating price pressures as we move into the third quarter?
Yeah, I mean, this pass through from the tariffs and is an argument that's being made by Bank of America, for example. They say core PCE in their eyes could reach 3.5% in May, nearly 70 basis points higher than it was a year ago. Pickup has been partly due to tariffs and one-offs, but the Fed is losing patience, it says, after the latest round of supply shocks. But as you said, you take out that headline rate, you look at the components, and they're not all facing the same direction. So it's going to be interesting.
Yeah, absolutely. And I think, the other question that needs to be answered, and this will only become clearer over the next 3, maybe 6 months, is at the moment, price pressures are relatively contained to energy. Do we start to see that broaden out among other areas of the economy? Because if we do, then that potentially strengthens the case for the Fed to actually respond from a policy perspective. But right now, we're not seeing that.
Yeah, sure. Right, we're coming to the end of the episode now, and just quickly to give everyone a heads up. Obviously, the situation in the Middle East remains fluid, although I'd say more positive than maybe some of the media want to give it credit for. We've got Eurozone PMI composites June prelims as well. So it's going to be interesting to see how Europe's coping with what we've seen on the geopolitical front. But it's probably a bit more encouraging underlying factors for the region itself. So one to watch there. Obviously, we got Australia data, busy week for Australia in terms of CPI and labour force survey as well, due up this week. And if you want to find out exactly what we got going on our website, you can go to the focus on the week ahead and give you everything else. That we got Canadian inflation data today. That's expected to firm by 0.3 percentage point. Again, the PMIs in there, Eurozone PMIs are pointed to send mixed messages, says our preview by Eric Culp this month, with analysts saying the manufacturing index is likely to slip 0.4 as the services measure edges 0.4 higher. So, and then we obviously got sentiment readings in the form of German IFO business index, which will be of interest. But again, it's all really all eyes will be on the PCE data out of the US this week as a market catalyst, I should say. Right, I'd like to thank Michael Brown. Mike, hey, thank you very much for taking part and all your wise words.
No, thanks for having me, mate. Always a pleasure.
Yeah, and we'll get your Troney on again as soon as you can, so you can take the mick out of him. So yeah, that's and anyone else listening, thank you. If you've missed the start of this, go back and listen on the socials or on the podcast platforms. Thank you for listening. Livesquawk.com is bringing you this. So if you want to keep up to speed with what's going on, please pay us a visit and take out a trial and see if it's something that's for you. Let us know what you're looking at. Let us know what you're thinking about and what you want us to cover down the line as well on the socials. So with that, thank you again to Mike. Thanks again for listening, and we'll see you again next time round. LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.